Hey guys, welcome back to another episode of Shifting Gears. My name's Grayson Harris. That's Henry Byers over there. Henry, we've got a little bit of news to cover today. I think the first thing that we want to kind of touch on is probably going to be the threat of a looming Canadian rail strike. You may think for people who are watching in the U.S. right now that it may not affect us in any way, but that really couldn't be much further from the truth. So what are some of the ways that you think that if this does come to fruition, how would that ultimately affect some of our domestic freight market, things that we are seeing down here?
Yeah, I mean, there's different elements when you talk about how it would impact the U.S. in terms of Canada-U.S. trade, but for it to stop, for rail traffic to stop, very significant. We deal mostly with freight that would travel in containers when you're talking about the moving between truckload and intermodal, which is 53-foot, 48-foot containers. So when you're talking about that segment specifically, there are a lot of companies that move freight. I mean, you have consumers in Canada too. You also have suppliers in Canada. So you're talking about a lot of those inbound, outbound goods between both countries coming to a stop. That becomes very significant because now you have to really plan alternate modes of transportation. Rail has been something that they've been incentivizing the intermodal carriers, and so you've seen rail pick up some decent volume here recently. But that being at stake is certainly gonna we've already seen it. We've already picked up a number of loads in the sense that they were supposed to move on the rail, now they're moving via truck. And so when you look at this chart here, Chicago to Toronto, it's just one lane, but you're essentially dropping off to nothing. And when you're talking about midnight tonight, and this would be Thursday, I guess it'd be August 22nd.
That's correct. Yeah.
Is when that work stoppage is set to take place. I think some people might have been optimistic it may not have happened, but I think it's getting so close that you've had to plan around it. And so I think you're seeing that come to fruition really here in the last couple of days, is where essentially the volumes that are being turned into the rail are going next to nothing at this point. Or somebody who is sending volume and getting containers, or just maybe it's freight that they can maybe afford a few weeks time on.
Yeah, there's like you mentioned, there's a lot of people that are already taking the precautions, including the Port of Vancouver. They've already taken some precautions in anticipation of the strike. So that's something that we'll definitely want to keep an eye on. It's moving so quickly that by the time that this gets out there, it will likely not be very up to date at all. So, feel free to check out some of that information on your own there. But this is basically us telling you, keep this on your radar if it wasn't already. And, if you think that your supply chain in the U.S. is immune to it, it's not. A lot of times, you're going to be relying on international trade. And yes, international does include Canada. And it doesn't really seem that way sometimes because it's right there, but same deal, obviously. So something to keep an eye on there. That's obviously the main thing going on in the freight market world right now. But Henry, what are some of the other things that you're looking at in your data that you've been seeing? Then what are some of the trends that have appeared in the last few weeks or so?
So let's just piggyback on the Canadian rail strike. So now you have a potential East Coast, Gulf Coast port strike coming here at the end of September. So when you're looking at managing your supply chain, let's say you move freight, in all these corridors, you do containerized ocean freight, U.S. imports, the East Coast, you do transborder, containers on the rail. Well, now you're trying to manage these exceptions in a way that really takes, a lot of time and effort. And that really takes away from the time you can spend, doing, what traffic is coming in and out of the U.S., even if it's West Coast. It's just one of those things where this volatility starts to compound, especially as we're nearing really a peak, holiday retail season for a lot of these customers. And so when we're talking about imports, we've seen these numbers show up at the Port of Los Angeles and Long Beach. We've seen them break records in July. So when you're thinking about that in the context of what's still coming, we're still looking at, and as of the most recent data point, it actually went higher. You're looking at an incredible amount of import volume still coming. So you're talking about not only the rail strike, you're not only talking about the East Coast labor strike, Gulf Coast ports. You're also talking about a huge influx of volume to the West Coast. And so when you look at that and how that is playing out on the rail is really front and center in my mind because a lot of that traffic that moves in those containers on the rail could be transloaded into dry vans. So when we're talking about the truckload market specifically, which is what we deal in most, you're starting to see a lot of potential volume building up for truck, a lot of transitioning between intermodal containers and trucks.
Yeah, I was going to say, if you look at these levels, I think something that's interesting to note here, as you can see, the other lines that are being compared to are just the last few years. You got 23, 22, and 21 up there. The fact that it is now higher than all three of those is absolutely of note. And I think that just kind of goes to what you said, right? Eventually, that's got to go somewhere, and it will likely spill over into the trucking market. So
yeah, absolutely. It's so if you looked at 2020, I mean, we're getting close to where that huge surge, COVID surge occurred when all that stimulus went into effect. Consumer demand really went super high. I mean, if you look at consumer demand for the second half of this year, it's not super bullish, but it is. These companies are looking. It's really they're going to make their best effort to, they're hoping that it increases year on year in terms of total spending. And so you're going to see them, stocking the shelves full in hopes that the consumers continue to show up, which consumers have been incredibly resilient. Mm-hmm. But if we look at how this is playing out, East Coast versus West Coast, you look at the rates that shippers are paying for their containers from China and East Asia. I mean, this is the most major corridor, the Trans-Pacific eastbound. We're looking at West Coast rates in white, East Coast rates in yellow. You would expect to see if volumes were dropping off significantly to the East Coast for that rate to start coming down. But what we're seeing is a couple things. Capacity still really tight on a lot of those vessels. And we really haven't gotten to that point where you're just definitely not going to make it to the East Coast. And then Charleston, interestingly enough, has surged recently. And so that surge into Charleston, because they're not necessarily held to the same stipulations by the International Longshoremen's Association, they may be perhaps unaffected. They're still going through some negotiations with the USMX, but it may not be as impacted. And so you're seeing rates really stabilize here. Yeah. And so when you look at shippers, they're paying this much for their containers. They're paying, well over what they were paying, double, essentially almost triple, depending on if you're going to East Coast or West Coast, more than they were paying, a year ago. So those costs are front and center, top of mind for a lot of these companies, because now their cost of goods are a lot higher than they expected. And now when you're looking at the rail's starting to get, a little bit of volume. If you look at to Memphis, to Detroit, to Houston, to Kansas City, to St. Louis, a lot of these lanes that, weren't picking up a ton of volume because a lot of that stuff would maybe have moved East Coast and then railed inland. You're starting to see this like mini land bridge is what they used to refer to it as. You haven't seen this in a few years, but they're starting to pick up even more volume. And so it's been interesting because I think that volume's at really high risk to spilling over into the truckload market, because the more congested those major corridors get, like Los Angeles to Chicago, the more impacted those longer haul inland moves, close to the Mississippi will become. So we're already seeing this shake out in the truckload sector. We've already seen, multiple pieces of spillover, expedite moves from California to places that we historically would have moved to East Coast and then move inland in a solo driver. So it's starting to pick up, and I think that urgency will only increase as we move forward. And a lot of that's attributed to really, again, back to the congestion, capacity, global capacity. We're looking at, Container Trade Statistics had published really a record-breaking June again for global container volumes. So capacity is really, at some of the lowest levels it's been in years. And then also you're having a situation where the transshipment ports are also ticking higher as far as congestion. Mm-hmm. So when we talked about the traffic jam for a couple episodes, the traffic jam just continues to build, and it's building very locally there on the West Coast, and specifically in the Southern California ports. I think it's high risk for anyone who's trying to move freight along those corridors. And I think that risk will only increase as time goes forward.
The question that would be on everybody's mind then basically is, what does it mean for me as a shipper that there's this much congestion going on at the ports, and that there's this much freight that's just sitting out there right now, and this much capacity that's just up for the taking?
Well, I don't think, it's not necessarily a vessel problem yet. Mm-hmm. You look at the ports that are hovering there off the port of Los Angeles, you don't see, it's nothing like the 100 ships waiting off a couple of years ago.
Sure, yeah.
So you're getting your freight here. It's probably not, that delayed. You may look at more direct sailings. But when you're talking about your ability to move that on the rail, I think that needs to be front and center. You need to think, okay, maybe those international moves that I'm seeing from Shanghai to Chicago, they may be attractive in terms of all-in cost perspective, but you may look at trying to terminate that on the West Coast as soon as possible, and just go ahead and let your team know the risk that we're going to have to be loading this in trucks and moving it inland is only increasing. Mm-hmm. So if you're looking at 25 days from now when those containers would land, try to terminate those and get those, transshipped. Try to rail them to your local DCs if you have them, and look to get those out by truck, because your risk that there's going to be major delays on the rail is incredibly high at this point. So let's look at the volumes. Yeah. And so this is what we're exposed to. We're seeing this huge surge in import volumes, and then that volume starting to arrive, and that's what you see in red. This is what Customs is reporting. So we see this volume as it leaves, we see it as it arrives. So the pressure's on, essentially, right? So that tsunami's hitting. We're already saying that it's going to continue. And so how's that playing out? Right now, the rails are doing a pretty good job at managing this volume. But this is incredible.
Yeah.
Approximately 600 more containers moving per day. This is a moving 7-day average from, out of the Los Angeles market. And like I said, this big spike is primarily due to the international volumes, which is in green or yellow here. The red volumes, which is which is domestic intermodal containers, not ticking up as high, still elevated for sure, but not yet touching, its peak that it saw, at the end of 2023, and then some of the prior peaks during the pandemic era. This international volume, like I said, shippers seeing those all-in costs are thinking, okay, East Coast port strike, what's the next best way to try to get it to the middle of the country? Let's go. Los Angeles does the container carriers obviously would be incentivizing this type of move because it's been typically lower volume. Mm-hmm. So they're incentivizing these inland moves, giving you a better rate than you would get in a truck to just rail it all the way in and terminate it. Again, Detroit, Kansas City, St. Louis, Houston, Memphis. I mean, it's really interesting to see some of the spikes in this volume, and specifically it's attributing to this big spike here in green. That said, that international volume, you start to get note of potential congestion. Tacoma actually had already put out a notice saying the rails might be backed up. We're literally looking at maybe the entire West Coast this occurring. So you're talking about East Coast port strikes. Now you're going West Coast. Well, it's just going to continue to build all this congestion. You're going to find yourself not able to get that freight on the rails and moving in a reliable timeline. Mm-hmm. You're going to have to rely on things like truck or, drayage to your local DC and moving it from there. So I think, they jumped in while the getting was good, and they achieved some, cost-effective rates inland. But I think those people are going to find themselves, left with delayed freight here soon. And we're already talking about if your freight's not here by September 1st, in your DCs, you're typically talking about missing some of the holiday retail season already. So we're just talking about high exposure to delays, the urgency increasing. And then, when this all happens, trucks become the most reliable means to transport goods. So this is really my thesis around, I've been holding on to this thread for a while, right? Yeah. It's almost like, people have been saying it's like a Michael Burry Big Short moment where he's like, you've seen him, everybody leaves and nobody believes. Yeah. But finally
you're in the office by yourself with the lights off.
Yeah. So let's just go back and say, okay, we talked about the tsunami coming in. We talked about how that could potentially spill over into truckload. The volume's here. It's surging to new all-time highs in truck and on the rail. So now we're talking about this is the moment. Has it played out, a little bit later than we had expected? Sure. But I think it just speaks to, how oversupplied the truck market is, but also and the rates have been low. So like you've already had people transitioning freight, but this right here is the big primary wake up call that this volume's here and the rails are likely to get backed up.
Yeah.
So now we're looking for the next week, 2 weeks, when you look at it on a truckload basis and seasonality, we're talking about a 10-cent increase when you're talking about spot rates for drive in all in. This forecast is not deviated, even though you have dropped a little lower. This is including fuel. Fuel's coming down. Mm-hmm. It's probably attributed to just fairly soft freight demand here soon or recently. We saw a nice little bit of volatility there before July 4th, but this is one of the strongest seasonal trends in trucking is this pre-Labor Day. In 2020, a lot of that maritime volume fed into this, and this the same issue we're talking about with the rails had started to occur a little bit. I don't know if you remember, but in 2021, rails were almost just flat out, denying some of these inland rail moves. Right. I think you could be talking about a situation where even if this doesn't go as high, that there's still tremendous risk on the backside of this. Mm-hmm. But this is an incredibly bullish forecast, and this is just based on seasonality alone. Mm-hmm. There are other factors, included in that calculation, but it's primarily weighted for seasonality here. And so I think you're talking about over a 10-cent increase between now and the middle of September.
Wow.
Well, what does that mean if you add an influx of demand from spillover freight on the rail? Because these loads that we've been seeing, that we've been paying attention to, are expedited team moves. That means they're late.
Yeah.
So already
they're not
seeing
just in a hurry. They're already late.
Right. So it's one thing to suspect it. It's another to see it already happening. And then it's a third to see that in conjunction with off the charts international rail volume moving inland. Regardless of if there's any vessel backup, this freight think about 600 containers. That's what we're talking about on the rail moving on a daily basis right now. Just take 600 containers and just put them out in a parking lot and see how much that is. I mean, we're talking about the trains didn't just add a bunch of rail cars. I mean, it's not been a super bullish freight period. This is largely a restocking cycle that, importers were caught off guard by a little bit elevated consumer spending. And now they found themselves low on inventory. Now they're gearing up for the holiday retail season. It all kind of converged. And that traffic jam has just been flowing steadily this way. So that's what I suspect. That's my Big Short type of moment. But I think, I've been getting a few people reach out saying, you were looking at this a month and a half ago, 2 months. And it's like, well, the data is just speaking for itself. It's just, we're looking at origin. We're trying to pay attention. That's why we created the index, is basically as that freight is being booked and loaded on vessels at origin, that ultimately is showing you what will arrive in the U.S. Mm-hmm. So it's a leading indicator. I mean, one of the best in the that really exists out there today as far as how containerized freight would influence whatever assets would haul containerized freight, which we all know at both intermodal and truckload, a lot of freight does come from overseas and touches a truck at some point.
Right. Right. So we've already seen at least a little bit of a jump in truckload activity, especially near those West Coast ports. Have we, or are we going to see, you think, this just the dam breaking, basically, of just here it is, it's now undeniable. What would be the moment you think that is apparent to everybody?
Long haul tender volumes, long haul, average length of hauls out of Southern California. We're seeing it pick up. It's not picking up at the rate that you would suspect if it was truly spilling over. I think that what happened prior to July 4th, we looked at some of those trends. It just spoke to how volatile things can get. It's not that the truckload is that much more balanced in terms of how many trucks are on the road relative to how much freight's on the road. It literally is more of a load imbalance thing where carriers start to flock, where rates are increasing, and you start to see that hurt capacity in other areas. It's worth noting, Savannah, if you go and you look at container tracking, I mean, we move a lot of drayage freight. Savannah capacity is already, in some cases 2 to 3 weeks out, depending on which carriers you're talking to. That's Savannah. They have a port strike coming up, right? So there's been a pretty decent influx of volume there. That's drayage, but for the truckload segment, we're seeing tender rejections in the Southeast start to pick back up. That could be attributed to with a hurricane coming in, and some of that volume getting picked up or getting delayed a little bit. But I do think you're seeing some tightness there where maybe we hadn't expected it quite yet. But that in conjunction with Flagstaff, Nevada, these markets right around Southern California are starting to pick up in rejections. And it makes you wonder if that trend is not already happening again, even though those long haul tender volumes haven't showed up, because a lot of that will be stuff that wasn't maybe contracted. It'll be a lot of volume influx into the spot market, and that'll be expedited, maybe perhaps unscheduled moves that'll start to occur. But I think you'll see it'll inevitably show up in spot rates, right? I mean, you would have to think that volume would be, spot rates would reflect that. Line haul rates have trickled up just a tad, but still, including fuel, you're looking at basically 2 days being flat here. So we're looking at seasonality here for spot rates. I mean, not too terribly much to see. I think we've already kind of covered that. Looking at the spread between contract rates and spot rates. I mean, this, basically just continues to add upon the thesis about, spot rates and the potential volatility that may exist. Contract rates within this last 2 months have really bottomed out. That trend, prior to July 4th actually caused a bit of an uptick in contracted rates. Spot rates have been So you're kind of seeing a little bit of an alligator mouth here, but I think that's likely. We're basically saying that that's likely to correct, and you start to see that gap close a little bit further. That'll put upwards pressure on spot rates, which will obviously lead contract rates in terms of any upward movement forward. But I think you're looking at spot rates putting perhaps as much pressure as they put on contract rates here in the weeks to come, if it really plays out like we maybe think it can.
Right.
From a volume perspective, you're now about 4% higher year over year. We call it really last year's trend. So this post July 4th, it's like this oddly quiet moment. You had a stock market drop real fast. You had, a presidential candidate almost assassinate. There's been all,
and then another one drop out.
Exactly. Yeah. So you've had all this volatility. It's created this odd kind of they call them summer doldrums. And, on a seasonal basis, it should have happened that way. But what we saw prior to July 4th was almost, it didn't reflect that mentality hardly at all. It was a very bullish moment. You saw all the signs that we're talking about, hopefully seeing, or not hopefully seeing, but we expect to see here soon, happen prior to July 4th. So we're really, volumes, demand is staying stable. We expect that to obviously increase if you look at seasonality. Again, this is one of the strongest seasonal trends in truckload, and if it doesn't occur and it doesn't play out and spill over in truckload, I would just be not only very surprised, it would be incredibly counter trend to what we've seen historically.
It'd be more alarming than anything.
It would be a very bearish moment, not just for truckload, but it'd be a very bearish moment for the economy at large, as the trucking market tends to lead the economy. We know industrial production, manufacturing is down. The ISM, which is the Institute of Supply Chain Purchasing Managers Index, it's an aggregate of a lot of these measures. This is a survey, but it's still pretty accurate in terms of being a predictor of recessionary periods.
Right. It's
been in contraction for the last 4 months. So the economy at large is not bullish by any stretch, but I do think that doesn't necessarily matter when you pile all this freight into the country at once and then you have all these strikes occur. You still can get a significant amount of volatility in the truckload sector, even though that long-term trend is not towards economic growth that's driving this next cycle. Yeah. It could be maybe a more super mini cycle in a sense, because again, if you don't sell through these goods in the holiday retail season, you're going to be left on the back end and maybe perhaps an excess of inventory, which we saw in 2022.
Right.
That'd be a very bearish sign for truckload. So we'll have to see. If the Fed drops interest rates, it could end up seeing a more prolonged period of growth. And maybe that's the plan, get everybody pulling back, reduce spending in some sectors, especially housing. That's kind of been in a freeze here, and you're seeing a lot of prices come down. So in terms of controlling inflation, it does seem like there's a lot of deflationary pressure. So maybe the Fed will end up reducing rates, but there's also a significant amount of stock market volatility that occurs when that happens. Historically, in 2008, it was the moment the Fed started to drop rates that it collapsed. So a lot of uncertainty. So let's just say that. So let's look at, Coyote Logistics. Chris Pickett created a Coyote curve. It's an aggregate of the Cass line haul index versus the spot market. It's contract versus spot, which we saw. FreightWaves doesn't have the history back as far. So, but Coyote was in existence in the last few cycles.
Right.
We are at the point where the spot rates cross contracts, right? That's the moment we're in. And 2025 is expecting a peak. This is FTR intelligence. We're looking at the beginning of the next cycle. They expect that to peak in 2025. It's usually happened that way for whatever reason. It seems to always, regardless of what's happening generally in the economy, it's a cyclical industry, right? Capacity bleeds off. But we're seeing capacity stay relatively resilient. And if spot rate boom, short-term mini cycle would create a lot of runway for these guys to stay in the market.
Sure.
We could perhaps see a mini cycle in a way where those projections are wrong, because now we've got this short mini cycle enables these guys to come on, and now you've got inventory. The economy, if it turns down, you could be, you have too much inventory on hand, and that would be a really bearish sign for a lot of these big importers, and that would reduce the amount of freight on the roads. Obviously, slide through some of these. This is a big one that's been talked about recently. We had the rate of carrier exits has actually decreased If you look at the number, basically the weekly average, and this is drew an average, really of that weekly average
Right.
for the last
the average of the weekly average.
Well, yeah. So
Okay.
so July, yes, because this is a weekly data set.
Yeah, I got
It's
you.
showing how many net carriers, like our carriers entering the market. Is it a net positive change, net negative change? We've seen, a lot of weeks of obviously negative changes since July 2022. An average weekly change of 338 carriers leaving the market then coming on.
Mm-hmm.
That has been, that weekly average has been, or that weekly amount, I should say, not an average, just a weekly total, or weekly net change negative has been decreasing. So this is actually interesting. This may say that there's actually that truckers, the people coming into the market, thinking about getting into the market, are actually looking at this whole situation playing out and thinking, there's maybe enough volatility to spark some opportunity here.
Right.
I certainly don't disagree. If you're paying attention to what we do, you're thinking that. So I think and that's how the market generally tends to play out. These data sets are not just hypothetical we just pull out of the sky. They're actually real data points on transactions that are happening in the real economy. So that's a really interesting one here. Reefer market's overperforming.
How about that?
Relatively unexpected. Spot rates continue to increase.
I was shocked by that. I was making sure I was reading that right.
Super strong period here for in the next couple months. Historically, again, looking at Labor Day for reefer. So, not only dry van freight, reefer rate also looking very strong seasonally as the confluence of all these factors. Reefer tender reject index staying, much higher than last year. Again, putting upward pressure on spot rates. Look at that seasonality in last year and then 2019.
Yeah, so you're going to see it go up here in a little bit.
Not so much in 2022, right? It was really kind of a bearish moment there for reefer and just the truckload market at large. You're coming off that really, massive surge 2020, 2022, the first month.
Yeah.
And then you had the great freight recession really began. Reefer volumes are actually flat year over year, but we're seeing a strong seasonal trend, obviously, in this next month. So we expect that to increase, but demand really not being the driver. What does this say? This says that it may perhaps be a little bit more balanced than the dry van segment. Maybe the reefer segment, we saw a really large reefer carrier go out of business a week ago or 2 weeks ago. And I think it just is one of those things where those carriers leaving, we're not talking about mode specifics. Perhaps the reefer market is a little bit better balanced in terms of supply and demand.
That makes sense because the produce volumes haven't been as high this year as they have been in previous years. So that would suggest, at least on a surface level, that volumes would be down for reefer. But I think that point you just made is a good one, that maybe the volumes in another year would be down, but because there maybe are less carriers in there and it's a little bit more balanced out, there's enough freight for enough drivers, that would explain something like that. So I'm glad you pointed that out because I was shocked, to be totally honest with you, that reefer was doing any kind of well.
And I also wonder if it's been so incredibly hot that some product, let's just say product can get up to 120, but can't go to 140. Some of that products may actually be being utilized in the reefer market, more of a protect from overheating type of scenario. You do have protect from freeze. I wonder if even alcohols in some cases, they don't want it to get up, that hot. It may mess with the chemical composition of these things. But it's one of those things I suspect maybe adding a little bit to it. But I think overall it's the better balance. Between the two that probably is driving it. Flatbed's got a lot of macroeconomic headwinds, housing market, industrial production, manufacturing, obviously not being incredibly bullish. So you're seeing some really, spot rates stabilize. You're probably seeing also contract carriers. And this is something that, even in the dry van segment may be happening, that pre-July 4th, shippers, if you look at the volatility there, they maybe understand their risk if they were to continue pushing contract rates down. Those higher rates are suspected, rates that are going to be, levels you want to maybe stick to your contracts. That could be, causing some deflationary pressure in the spot market, or at least causing the stabilizing in spot rates, because that contracted volume is obviously not the spot rates, right? So less volume perhaps hitting the spot market. And I think just overall from a demand perspective, we would say that is certainly true.
Gotcha.
And then I think, year over year down in flatbed spot rates, that's likely to continue and persist, especially in the next month.
Sure.
Look at that relative to housing starts. Housing starts have been printing pretty significant downward trend for this year. So that really is something that will put, would be a macroeconomic headwind for.
Right.
But the Fed lowering interest rates, there are some reasons to suspect that, you may be seeing somewhat of a bottom here for spot rates and flatbed. And perhaps we may see it catch maybe the next cycle, but maybe lag dry van if the economy does.
I mean, it can't go much lower.
No, it's definitely
not
pretty low.
Much. It can go lower, but not that much. At least based on these historical numbers we're looking at here. So,
and this is the reject index, obviously. So like spot rate, this is putting deflationary pressure on spot rates.
Right.
In dry van, you basically would say anywhere over 7% is inflationary for spot rates. Flatbed just slightly different, but at the same time, that trend is showing that it's a softer market.
Right.
And I think it just is a testament to the macroeconomic headwinds.
Right. So based on everything that we kind of talked about today, I think the main point really is just that this influx of freight that we had been alluding to over the past couple months is, for all intents and purposes, pretty much here now. It's just a matter of, when is it going to lead to the dam breaking and to overwhelm the rails to the point where now we have to start bringing in the trucks. There's a sense of urgency. Spot rates go up. There's more rejections, things like that. With all that in mind, what's some advice that you would give to shippers that would help them sort of prepare themselves now, and then also, what are some ways that KCH specifically can help them navigate this time of volatility? Because things are changing and they need to be ready for it.
So when you look at this wave of imports arriving and it's creating, congestion at the ports, we're likely to see that only increase because we're talking about that wave of imports is not, died off. It's still looking at increasing in some cases at some of these major ports. You had a record-breaking July at Port of Los Angeles, the Port of Long Beach. You're looking at, beyond record volumes on the international front, international containers on the rail. So when you think about having to move to other modes, you're looking at, transshipping those volumes into trucks, expediting those. KCH, that's really our bread and butter. It's that time-sensitive, urgent freight that you're going to need that white glove service on. Transloading that volume into 53-foot dry vans and expediting that with a team if you need, or just doing a solo is something that we know extremely well. We've had a lot of experience with that, especially during the pandemic era. So the time is now to prepare for rail congestion. You've got the rail strike in Canada. Even if that wasn't happening, I would still be saying this. You're seeing Tacoma already warn of it. There's only so many rail, ways from those coastal ports on the West Coast inland. And I think you're going to see the rails increasingly exposed to congestion and service issues. And if when you can't put it on the rail or it's going to take too long, truck is going to be your best option. So no doubt, be preparing now, get those options in place, go ahead and get them scheduled and try to get those, containers out of the port as soon as possible via drayage or get them to a transshipment facility, transloading facility, get them in 53-foot dry vans, and we'll take care of it from beginning to end.
Perfectly well said right there. I think just one more thing I would add to that, man, and it is stay informed. It is look at some of these numbers here, and if you don't know where to find them, come to us. Look at our social media pages. You can find us on LinkedIn where we post some of the clips from these episodes. If you don't have time to watch the full episode, we get it. We're all working. We got some time that we need to spend doing our actual working things. So if you need to go and see some clips and sort of just figure out really quickly what's going on in the freight market world, we've got all that information for you down in the description. Staying informed really is the best way to prepare yourself for things like this. And also having a partner like KCH as well. That doesn't hurt at all, does it? So appreciate you guys watching this episode here. Like I said, if you need to find anything from us, it'll be down in the description below. Thank you again for watching, and we'll catch you next time. See ya.
See you later.